Hi, I'm Martin McGrath, Financial Leadership. We're financial planners that specialise in retirement planning. And I want to take you through a bit of a case study today, talking about a client situation where they've got some shares in their own name. We're helping these clients get their superannuation sorted, set up for retirement, understand their requirements in retirement and what that means. Part of that is doing a full review of the whole situation. What are your super funds doing? What are your assets outside? How's your loans going? Your cash? And in their case, the shares. So they had, give or take, about $400,000 in shares in their own name ticking along. And they were pretty happy with how they were going. They were getting some good dividends on those. Some they inherited, some they purchased themselves. Everyone's situation is different. And that was making them about $20,000 a year in dividends. So a pretty good result, nice healthy return, about 5% a year in dividends. Dividends from shares also come with another thing called a franking credit, which is a tax credit that comes with your dividends. I've got another video talking about franking credits, how that works. I won't delve into that now, but it's a tax credit that comes with that. The good thing about dividends is it's good income, but in your personal name, you have to pay tax on it every year. In their situation, they were still working, earning a bit of income. They also had another rental property that was earning some income into their name. It meant that those dividends, they were having to pay tax on. The franking credits did actually reduce some of that tax, but it didn't eliminate it all in their situation. So we looked at where things were sitting at. Actually, the shares were pretty happy. I was pretty happy how they were invested, some quality companies. So I wasn't looking to make some change in particular the shares themselves, but more importantly, where they were being held. Because what I explained with these guys and explained to you now is that if we looked at where they're being held and considered another structure, sometimes it's a company, sometimes it's a trust, in this case it's a super fund, we picked up those shares and moved them into super. They're in their early 60s, so we could do that. They're also in their early 60s, means they can get access to that money if they need it back. So we weren't locking it away for 10 years, they couldn't touch or anything like that. We were just moving into a much better tax environment. So much so in their case, they pay no tax on their super. Zero. Zero on the dividends, zero tax when they take it out, and zero tax on any capital gains. And the way that the rules work in that case is the franking credits that exist at 30%, they actually get them back as refunds. So what that means is that's about $8,500 a year in tax that they're going to save or be better off by having the exact same shares just in the right structure, the right asset in the right name. Now you figure that out. If they're in the early 60s, it's $8,500 a year every year. If they've got 25, 30, 35 years to live, we're talking about some pretty big savings. If it's 30 years, it's over $250,000 in tax saved by moving that into the right area. So we don't have to change the asset. We need to make sure it's held in the most efficient manner. Their situation is different. Everyone's situation is different. But even they go, well, we don't need to move those shares. We're happy how they're sitting. Let's just leave them as they are. It's our job to make sure we explain the best opportunities and what we can see as a massive saving. And fair to say, $250,000 is well worth saving, and we structured that correctly for that case. Fair to say that's paid for our fees 20, 30 times over in savings for them over the next how many years for the rest of their lives. Hopefully that makes sense in your situation. That might help, or someone who's in this situation. Feel free to reach out. Happy to have a chat. But it's important to remember that the right asset in the right name is where we want to be.